Bank of Canada announces the second consecutive back-to-back interest rate cut. We started as high as 5 with 2 back-to-back cuts. We're now 4.5. And how much more do we have to go? And what kind of impact is it going to have on this market now that we have a second rate cut? I'm going to be giving you my thoughts and explaining all of what I see right now from the data side on this week's episode of Prime Properties TV. Now, if you're looking for some help on how to navigate the real estate market and what to do with this upcoming fall market, because usually August tends to be a little bit slower, which is kind of what we're heading into. But a lot of people are, thinking about what to do with their real estate in the fall and kind of just saying, hey, here's the plan, let's get ready. But peace out, I'm going on summer vacation. That's generally what happens at around this time. So if you do want to chat to me about kind of what your plans are for the fall, you can book a call with me using the link that's on the screen right here. It's www.chatwithzen.com. Simply click on the date and a time that works best for you. And then when you see the prompt, fill in your name, email, mobile phone number, and the question you have for me, and then we'll chat then. Good day, Toronto. Welcome to another episode of Prime Properties TV. My name is Zhen, and if you're enjoying the content I'm putting out there, do me a favor and like and subscribe. What we're going to be reviewing today is the Bank of Canada cuts interest rates further. So as expected, the Bank of Canada decides to cut the interest rate, the overnight rate, from 4.75 to 4.5%. So remember, we started at 5, and now we're down 50 basis points from the last rate cut, which was in June. So as more and more information came out with the inflation and the jobs data, it didn't really matter what the US was doing, et cetera, et cetera. Tiff Macklem, the head of Bank of Canada, even said that if there's something they're going to sacrifice, it's going to be the currency. So it really tells a sign that, hey, look, be prepared for more rate cuts. Now, do keep in mind, the next announcement date will be September 2nd or 3rd, right after Labor Day weekend, which kind of starts off the fall real estate market. And are we going to have another one? Again, it's going to be data dependent, but I would not be surprised if we have 3. Remember what I was saying in the beginning of the year? I was saying, look, if we get 3 rate cuts or more than that, I think we're in a recession. And I think that's what the data is showing right now. So you have to keep in mind, let's not celebrate the fact that there's a rate cut right now, because just because there's one doesn't mean the market is going to come back. So a lot of people who are trying to cheerleader on the market right now, I really don't think this rate cut is going to move the needle at all, especially the fact that it's coming in at the end of July. Now, there's no announcement in August, but August tends to be the second most dead month in terms of activity, so like sales and stuff in the real estate market. So I don't expect much hurrah, everyone's kind of, looking to buy something again. And just from all the people I'm talking to, even if they did have some plans, they say, we're just gonna wait till the fall because everybody that's Canadian at least wants to enjoy, what little short summer we have, right? So I don't think this rate cut moves the needle. Now, can the third consecutive rate cut that comes at September move the needle? Potentially, right? But there's always going to be some issues that we're looking at. And the big one is the recession word, right? So are we going to be in a hard landing where a lot of people are losing jobs? And if you're losing jobs, you're basically going to have a hard time buying, which removes a lot of buyers out of the pool for the amount of listings that we have right now on the market. Now, granted, if you're a doctor, a dentist, a lawyer, an accountant with a very low probability of losing a job, yeah, you can obviously still buy and they're still in the market, but that doesn't mean everybody else is going to be back in the market, especially if they're afraid of losing their job, right? Because if you're afraid of losing your job, you don't have income, you're not concerned about what your mortgage payments are. It's can you even make those mortgage payments, right? So you have to have that kind of mindset. So I don't expect, even if we get a third rate cut, the market to come roaring back. I think we're going to have a lot of inventory kind of get absorbed, which I'll show later on in this video. Now, one of the charts I want to show you here is the reason why I do think we're going to have more rate cuts is if you back out the interest over here, which is in the orange bars, the inflation is already sub 2%. Canada is the only nation that uses interest on mortgage as part of the CPI, which means that if you increase interest, technically that component of inflation increases because you just increase it. It's like a circular reference, right? It's like a dog chasing its own tail. So the fact that we have this and we remove it, it's already inflation's already come down. So there's more, call it leeway for the Bank of Canada to cut, right? Obviously not necessarily just looking at that, but I'm just saying this is what the data says. And the second thing is that in May, they rejiggied the composite of the basket of CPI, meaning what percentage of what. And what they basically did is they increased the weighing, meaning the percentage of how much mortgage interest accounts for the total CPI basket. They increased it, which means that it's going to account for more. So in layman terms, what that basically means is that as we cut interest rates in the coming months or coming years, it's going to have a greater and greater effect on lowering the CPI because what we're cutting, the thing that Bank of Canada control, this orange bar, is weighed more. You see what I mean? So when we look at kind of where inflation is when you remove out the mortgage interest component, This is where they had the change. This was in June and it's at 1.4. There's a lot of runway for kind of Bank of Canada to continue cutting. But is this still a time to get, a variable versus a fixed? And again, that really just depends on the spread between the two. And you have to keep in mind, like the variable has to come down quite a lot to match the fixed right now. So, if you're asking me, I still think fixed makes more sense if it's a 3-year term because the cost towards the end of it to break it is not that bad, right? So a lot of people have asked me that. Oh, that's just my 2 cents. Now, the reason why I think we're going to have a hard time with the markets right now is, yes, interest rates are great. They're coming down. And I've always said in the short term, inventory dictates where the markets are going to go. And that's why I can always generally get an idea of where the market's going to go in the next 30 to 90 days because inventory dictates that. Anything after 90 days, it's inventory plus interest rate and sentiment, right? So all this Bank of Canada rate cut stuff is more so like, hey, what's going to look like in fall or maybe the end of fall in December and like Christmas time or maybe 2024. But where the market's going to be in fall really is dictated by the inventory. And when I look at the inventory, this is at the end of June, you can see we have about 22,000 active listings. Now, the July numbers are not out yet, and I checked this morning, and we're almost at 25,000, meaning that we're going to pin it all the way up here, right here. It's a lot of listings. And for the record, we were at like 10,000, 8,000 listings when things were born. So we're at 2.5x the listing. And when there's a lot of stuff to buy, buyers are taking their time, and they're not kind of as motivated to kind of buy because there's a lot more sellers and more options, right? So that's why it's going to take, inventory to come down to maybe like 15,000 before we start seeing like, price improvements on the kind of entire like macro level for the real estate market in GTA, right? So that's why I don't think that there's gonna be a bull run with this other, rate cut that we saw this week. This is why I don't think we're gonna have a massive bull run until we have a lot of this inventory cleared out, right? And it's just very simple. You don't have to overcomplicate it. Just look at inventory. A lot of stuff to buy from. People aren't gonna be bidding it up, right? It's that simple as that. Now, when I look at the months of inventory, which is generally the biggest indicator of where the market's going to be, you can see right now at the end of June, we're at 3.2. I just checked again this morning when I kind of made this video. We're at like 3.5 right now, and condos in the 4 and 6 area, like South of Steele, is getting close to 6. So this is a very high month of inventory, and you can kind of see we haven't seen this kind of inventory essentially since like before the great financial crisis. We kind of saw the remnants of this in 2017 after the foreign buyer tax, and we kind of saw remnants of this after the massive rate hike that we saw after 2022 starting in March to July, right? So you can see we trump most of them. So when you have sales at such a low volume and people are still listing, like I was saying like a few months earlier, there's a lot of pent up sellers, and I think there's a lot more pent up sellers than there are pent up buyers. Inventory continue building. So for us to really start seeing any kind of price appreciation or any kind of balancing where prices aren't going to fall instead of increase, we really need to get inventory back down to like 2 months. At 3, I actually think prices may begin to fall, right? So yes, there's a rate cut, and yes, there's a chance that prices will fall because recession is coming. So these are all the things that I'm personally looking at right now that you have to kind of consider. So if you kind of understand what I was just explaining in this video, you'll know that things are just turbulent. It means that the rates are going to come down, but the amount of inventory is so high. So it's kind of like you have a crisscross of where things are going to go. So at the moment in the short term, I don't think prices are going up. If anything, they could be coming down because we're getting close to 25,000 active listings. And we have to see probably a few more rate cuts before maybe people are back in the market. But the question becomes, when we see more rate cuts, we're going to be in a recession. How many people are actually in the market because they have fear of losing their job, right? So you can see we're in a very turbulent time right now. So if you are looking for some help on how to navigate this real estate market, you could do so by booking a call with me. There's a link that's on the screen right here. It's www.chatwithzen.com. Until next time, your move, your future. See ya. Now that you're done watching this one, how about this one or this one? You know what? Just watch them both.